Good morning. Thank you all for joining us today for Lytham Partners Fall 2023 Investor Conference. My name is Joe Dorame, Managing Partner of Lytham Partners. I would like to welcome Flow Beverage, a premium and sustainable water company. The ticker symbols are FLOW on the Toronto and FLWBF on the OTCQX. Presenting from the company today is Trent McDonald, Chief Financial Officer. As a reminder, management will be available for one-on-one virtual meetings. If you'd like to sign up, please visit our website at lythampartners.com/virtual and click the one-on-one meeting request button. Now I'd like to turn the presentation over to Trent McDonald, Chief Financial Officer of Flow Beverage. Trent, please proceed.
Thank you, Joe, and thank you for having us here. Quickly, just going through the disclaimer. Okay, so for those who don't know the Flow story, it actually started with our founder, CEO, and chairman, Nicholas Richenbach, who founded it in 2014 off the back of his family's spring. And the water that he had grown up on was a premium water that he had enjoyed his whole life. And he dreamt of bringing that to the masses in the most sustainable packaging on the planet. And that is what really started it. And so since then, we've been doing just that, bringing it to consumer after consumer. We have an extremely passionate consumer base, and that consumer base continues to grow up until including today. The water is naturally alkaline, 8.1 pH level, and it's got lots of great qualities in it, very high in electrolytes, naturally occurring electrolytes. And we have an abundant supply coming out of that natural artesian spring. And so it's a wonderful, wonderful, source of water for those consumers who want to try it and continue to try it every day. We also have an extremely high focus on sustainability and ESG as an organization. In fact, we have such a high ESG score that it puts us as the most sustainable beverage company in the world, and in the top 5% of all companies who are B Corp ESG rated organizations. Our portfolio, we take a portfolio approach to water and to refreshments, beverages. We have obviously what we call our OG, which is just the natural organic water that you see, which is the 1 liter and 500 ml. But we also have other flavored waters, and we keep a portfolio of those going from cucumber mint and strawberry rose to blackberry hibiscus and others. In addition to that, we're very high on innovation. So we have started our vitamin water about 7-8 months ago. That has 3 flavors and is currently focused on immunity. But we do plan on doing things around that portfolio to increase this number of SKUs and the functionality. So that's something to look forward to. So with that being the case, we have, again, our company, we have extremely loyal customers. And our customers tend to enjoy our beverages. We have a very specific consumer base that we target to, and that is our 70% of our sales. And we have a high promoter score of 79, which is something we're very, very proud of. Some of the things that are going on with the company, however, is that, and we are very, very aware of this, is that, our company, while we have wonderful sales that continue to grow and a wonderful consumer base to which I just referred, the company itself, when I came in about a year ago, a little over a year ago, and Nick came back in as CEO about 6 weeks before that, we together knew, as a lot of the SLT members at the company knew, and certainly the board, who is a wonderful group of individuals that make up our board today, we knew that we needed to do things to transform the organization and make it profitable and provide that clear path to profitability that was lacking, just a year ago. And so we came up with a lot of things, and I want to provide a bit of an update on where we are today. The first thing we did is we had to sell one of our 2 production facilities, which was located in Verona, Virginia. We received proceeds of $19.5 million US, $6.3 million of which was debt through lease assignments. And we entered into a co-pack agreement with the purchaser, which we have more recently decided to move a lot of that into Aurora. Corporately, we got a secured debt of $20 million, which we felt was great for us at the time. And we did that in early January of 2023. And more recently, we've extended our unsecured debt repayment, which was due in February 2024, by another 2 years, which is great for us. So that's not hanging over us as a cash flow implication in the near term. We have completed a cross-functional restructuring subsequent to those financing things that we've done, and that took place in June. And we also went with an entirely new IT ecosystem, which went live in early May. All of which has built for us a much better foundation on which to grow and to become profitable. We also added 2 new board members, Stephen Smith and Michael Lines, both of whom are extremely experienced and wonderful members of the board. In recent progress, you can see that our Flow branded growth was 21% in Q3 and 46% year to date. The 21% in Q3 comes off of a 98% growth in Q2, and together are much higher than last year. Last year, there was some timing differences, and so we had a very, very aggressively great Q3, and the fact that we comped that with a 22% growth again was kudos to us. Gross margin continues to be in the low 20s, although with all of the things that we've done to date and we are about to execute on, which I'll get into a little later in the presentation on logistics and distribution, we anticipate those going up dramatically over the next 2 to 3 quarters. Right now, one last thing that we're trying to do is we're trying to now, off the back of all of the reorganization we've done and the things that we've done to help with our balance sheet and to mitigate cash outflows, we are now at a point where we're into our last of what we call our 4-pillar plan, which is the divestiture of our Aurora production facility, which is advancing through a brokered process. And again, we are executing on a third-party logistics plan, which again is going to save the company a tremendous amount of money. We actually have it at between $9 and $11 million per year based on the comprehensive RFP process we ran after completely redesigning our go-to-market strategy through some world-class consultants on logistics. And so we are very confident in that dollar savings figure on an annualized basis. We now have cash of $7.6 million and working capital of $12.3 million as of Q3 2023, which is a dramatic improvement from where we were just 1 year ago at October 31st of 2022, where we had $2.3 million sitting in our bank account. The trajectory continues to grow. As we talked about with our sales over and over, we're up to close to 60,000 doors of distribution, and we have a wonderful group of partners that we deal with each and every day here in Canada and in the United States. Most recently, we managed to get distribution through all of Starbucks channels in here in Canada, and what that did was it allowed us to grow our e-com in Canada by 75% year over year in Q3. And that's the strategy that we continue to use in food service. But that being the case, we have wonderful partners across the board from, Pepsi in the New York area for the most part, and Office Depot and Target and Costco, CVS, Whole Foods. Whole Foods is a wonderful partner of ours, as is Costco and so many others. So we have been doing very well in getting new doors open for us each and every day. Here you can see our Flow branded growth over the last 7 quarters, and you can see here that each quarter we do very well. Last year in Q2 we had a dip, but then that was made up in Q3. You can see the actual numbers of 4.8 million going all the way up to 8.6 in 1 quarter, which is significant growth. So that was just timing differences between Q2 and Q3. And this year, of course, we overlapped that quite easily and grew tremendously. So this year in Q3, we had 10.5 million, which was in Flow branded net revenue, which is the highest we've ever had in our history, and the first time we've ever beat $10 million in a single quarter. We still maintain our market share growth, and you can see from Q3 of last year to Q3 of this year, we increased our market share in carton format to 49% off of a base of 44%, while others have gone down. And so we continue to take share from other waters in the same format. Some of the operational milestones we've had more recently, we expanded again to over 59,000 stores. That's a 63% increase year over year, which we find to be a tremendous achievement on our part. We've gotten into Family Dollar, Dollar Tree, Albertsons, Safeway, Save On Foods, and Circle K, all of which are great partners for us. We've maintained that #1 market share in U.S. carton format. In food service, which is a strategy that we use where we go in and it promotes trial over and over. We then take those individuals and we hope through some of the things that we do inherently that it turns into great conversion and they start buying in higher margin channels, like again, e-com or through club pack or retail. And so that's something that we've taken seriously and something that has been working for us over the last several years. And as we get more refined in the kinds of food service that we like to work with, like a Starbucks, it is becoming more and more effective. We also entered into contracts recently, as we announced, with Live Nation, which does close to 2 million, concert goers every year throughout Canada. Lots of wonderful venues like Budweiser Stage in Toronto, where now Flow is the water that you buy at those venues, and we do a lot of sampling programs as concert goers leave the venue, so they have another opportunity to trial our products. Again, we launched at Starbucks, 1,100 Starbucks across Canada, which is going tremendously well for us. And again, it has been leading to some great conversion. Innovation, we talked about already with vitamin infused water, which is now itself in 8,000 locations in North America, including Albertsons, Safeway, and Circle K here in Canada. Some of the financial highlights, Flow branded net revenue, again, 10.5 million in Q3, which is 21% increase from our really good quarter last year, 27.2 million year to date, which is a 46% increase. And the drivers of that, again, are food service, new stores, e-com, and our innovation. Consolidated net revenue, including our co-packing services, was 13.8 million in Q3, which is an 8% increase from Q3 of last year, and 37.6 million year to date, which is a 12% increase. And again, the reason that they are lower is because we have not been focused as much on co-pack because of the lowering of that revenue stream coming out of Verona. So when we divested of Verona, all of that co-pack tended to disappear, and we've moved it into what we could into Aurora. And we still have some great partners in co-pack that we continue to co-pack for each and every day. And so that has been working well for us. But again, it has been rather flat compared to last year, and in fact, a little bit down. Gross margin is 21%, 22% year to date. And again, it's the sales mix as we continue to work towards conversion. And we did have some e-com fulfillment methodology and service interruptions in the current quarter, which led to us not being able to show the progression in cost of goods declines the way we would have liked in Q3, but we anticipate in Q4 and then certainly in Q1 and Q2, the market will start to see what we've been doing in terms of those cost of goods savings, especially when it comes to logistics and distribution, much of which gets allocated into cost of goods, and what the impact of that is going to be. And of course, conversion as we continue to move people into higher margin channels out of food service. Our EBITDA loss was 9.7 million in Q3 compared to 8.9 last year. And there was a lot of drivers of that, including the fact that we are in the middle of a huge transformation, and we had about 3.8 million of non-recurring costs that we incurred in Q3 associated with a lot of that transformation, which we do not anticipate will continue to repeat itself in Q4 and then certainly into Q1 and Q2. So going back to where we are, we have sales and marketing, and I talked about our Flow branded product and what the co-pack revenue is. As you can see, it's down year over year. Gross profit is also down as a number and as a percent because of some of the things we just talked about. Sales and marketing is flat to down from last year, while G&A is up and salaries and benefits are down. General and administrative have a lot of those one-time costs in the 3 months that I just talked about, and normalized will be much lower going forward. And so we anticipate our EBITDA loss and adjusted EBITDA loss are going to improve dramatically as we go forward as well, specifically as we get into next fiscal year, which starts November 1st. And this is where we get back to unlocking shareholder value. We know as an organization that we have to do better, and we've taken that very, very seriously over this past year. While we are continuing to trade at a very, very, very low multiple of our forward sales and in our trailing sales compared to our peer group, we continue to have really good growth on certainly the Flow brand, and even on a consolidated basis. But that being the case, we need to be profitable, and we have to have a path to profitability. And we knew that, and we have to stop burning the cash that people have seen in our publicly released financials. And we have done so much that people can't see yet because it's only been recent, starting with, again, the things that we did last year with divesting at Verona and then getting in a piece of debt. But that just bought us time, and that time had to be used for restructuring the organization. And so what we did was we got to work. And we completely dismantled and implemented an entirely new IT ecosystem, again, back in May, which then went live and allowed us to have a foundation on which we could then reorganize other functional areas like finance and HR and legal and IT itself. We did that and announced it to the market in June, where we decreased our headcount, non-logistics, non-operational headcount by 30%. But truthfully, we're at 45% of the headcount we were this time last year in all those functional areas, because we had already done some things prior to that larger announcement. You don't see that because our last financial statements were actually only up to July 31st. So you're not seeing the total impact of these things that we've been doing. Again, with the with the logistics and distribution, that was a huge, huge, huge area of expense for us that we never handled well. And we aren't logistical experts. We aren't warehousing experts. We are not distribution experts. But what we have done is got some very, very profound experts in to redesign what that looks like and to go to RFP. And then we had to build out EDI interfaces between ourselves and our chosen partners. And all of that is now going live. And we know we're going to save $9 to $11 million per year. That's a massive amount. And it's going to help our cost of goods, and it's going to help our cash outflows. So all of these things you're not going to see in our financials until, what is coming, Q4 to a degree for sure. But then, of course, Q1 and Q2, given our fiscal year ends October 31st, which leads us to that last piece of the pie, which is, of course, and what we're talking about here is the asset light model and unlocking shareholder value through the divestiture of our only owned production facility in Aurora, Ontario. And we are doing that as we speak. We're well down the path of a broker process, and we are using great partners to broker that process. And have all kinds of interested parties because it's a very efficient, well-run operation that happens to have some very positive EBITDA. And so that being the case, we know that we will, we have a lot of faith and trust that we are going to be able to divest of that in a timely manner. And then that will lead us to a path to profitability off the back of that, because we have now an extremely simplified company focused on brand and brand development and putting that money instead of into operations, taking that divestiture and having the money to then put into marketing and sponsorship agreements and trade spend and in-store merchandising and the things that develop inherently your brand. And so we will be doing that in the very near term. And in the meantime, we're going to be saving, between 22 to 26 million per year in overall cost improvement. And hopefully, if this all goes the way we believe it will be, and we have every indication that it will, we would be debt-free coming off the back of such a divestiture. And that would allow us to not have to put cash flow into debt servicing. So there's a lot of things that are still to come that we're in the middle of executing on, to combined with that which we already executed on. So there's a lot of good things that we see in front of us versus what's been behind us. So with that being said, we always say it's a beautiful day to invest in the future, as we do holistically as an organization. And we believe, at some point we unlock shareholder value, and that is what we've been completely focused on. And our shareholders and stakeholders deserve for us to do that. And that is what we intend to do. Thank you for your time, and have a wonderful day.
All right. Well, Trent, thank you very much for the overview. Let's expand a bit on a few topics. Can you provide a little bit more color on your transformation plan? I know you've talked about it here in the presentation. When did you start, and why is it so important that you're successful in making this execution on the plan?
Yeah, great question, Joe. We started when I came here, and it's a funny story, but I had actually been cold called and recruited into this organization. I said no twice before coming here because I saw actually a path to insolvency more than a path to profitability. And when Nick came back and he wanted to speak to me and then we got together, he was open to and conveyed that the board was open to do things that were extremely transformational. To his credit and to the board's credit, and everyone in the team here at Flow has been solely focused on it. I'm just one piece of that puzzle. And so when we came in, that was it. That was the impetus. We knew we needed to have a path to profitability to not only avoid insolvency, but to actually provide a return to investors. And so we've been solely focused on that for a little over a year now. And the 4-pillar plan, which is really around the divestiture of Verona, the secured financing, the first 2 pillars of which provided us nothing other than time to do what we needed to do to mitigate cash flow and put us on that path, then led to that. And those 4 pillars are like the restructuring, and then of course the divestiture ultimately of Aurora. And we've been focused on that. We've been focused on it. And it's not easy to restructure an entire company from scratch. I always use the analogy, it's a lot easier to build a foundation under a house when you just have a piece of property and you're digging a hole and putting in a foundation. It's a lot more difficult when there's already a house built on a foundation, because now you have to get cranes in, lift up the house, unattach the wiring, the plumbing. It's a very complex project. And so for us, there was already a lot on the go. We'd made a company that should have been simple, very complex. And so it's hard to dismantle that and rebuild it the right way. It takes time. Here we are, it's October of 2023. We only started this a year ago. So we've made a ton of progress in a very short period of time. But again, shareholders aren't seeing that. The market isn't seeing that because, the financials that are out there don't reflect it all. By the time we got the financing in place in January and started building towards a new foundation, you don't do that in 5-6 months and actually have it so much completed that it's reflected in your financials. That's not how it works. And so we anticipate going forward, we're going to see the fruits of our labor, and hopefully it's going to be a good thing, and we start to unlock that shareholder value, which is really an extremely important thing for us and something we're solely focused on.
That's very helpful. When do you expect the Aurora facility to be sold, and what level of proceeds can the investors expect?
Yeah, look, I mean, we've been at it for a bit here now, and we're advancing down the path. I can't say with certainty when exactly it will close, but our goal is to have it closed by the end of this calendar year, and certainly no further than say January, February of next year. This being October now, so we believe we're getting very close. We have, again, a lot of world-class interested partners, coming to the table, or parties, I should say, instead of partners, coming to the table who see the value in that plant. When it comes to the actual valuation, that obviously will be negotiated between us and whoever it is that purchases the facility. But that being the case, it's not Verona. This is a highly profitable it's a highly profitable facility, and it has room for expansion. It's on great distribution channels. It's a very, very, very good opportunity for the right player coming in to purchase it. So we anticipate that we're going to get materially more than we did for Verona. Now, what that looks like, I don't know, in terms of a multiple, 2 multiple, 3 multiple, 4 multiple, I don't know. But I can tell you it is much, much, much more valuable than Verona, and materially so.
Very good. Once the sale is completed, what are your plans for the proceeds?
Yeah, I mean, again, the first thing that happens is out of those proceeds is that we pay off all the debt to ensure that it's the assets that are being taken over by whatever parties coming in are unencumbered. So we will be paying off all of our secured debt, and then there's some unsecured debt that we will be paying off at the same time as well, which will leave us debt free. and from, for the most part, that we will have very little debt after that, and debt servicing will have been mitigated, dramatically, which is a huge cost for us. And so off the back of that, the remaining proceeds, which we anticipate to be fairly substantial, will be used to develop our brands. And that's going to be important for us. We have great growth today, and we want to continue to that growth, and in fact, accelerate that growth. And that's going to take a lot of marketing spend, trade spend, and putting money into retail and into our partners, and into innovation. And so that's where we're going to go with this. And so we anticipate that will bear some fruit over the next, 6 to 8 quarters, and that it'll provide that path to profitability, in addition, when combined with all the things we've already done in terms of cost restructuring.
Makes a lot of sense. In the presentation, you had touched on your partnership with Live Nation that just came about here recently. How is it going? And, is this Canada only, and if it is Canada only, what's the opportunity potentially for the US market with Live Nation?
Yeah, it is Canada only, as is Starbucks. And both have been working great. Live Nation has been a pleasure to work with, and I can tell you the concert goers enjoy the water. And I've been to one of the concerts, post us doing our sponsorship, and there's Flow everywhere, and it's wonderful to see people drinking Flow in front of you as you're watching, and and all of the flows being given away as concert goers leave the venue. It's been great, and you can see it in our e-com, and you can see it in our sales here in Canada. Canada's been on fire for Flow for a while now, and it just continues to accelerate. In the US, look, we have some other food service partners that we deal with that we find a lot of value in today, like Accor Hotels and Norwegian Cruise Lines. And we are in constant conversations with other food service providers. And that's so while Live Nation is not there, and we're not in Starbucks in the US, you never say never. And we're constantly looking for great partners that can provide trial to consumers within our target category. And so we have to be very careful about where we target this, because it's an investment, and so you don't want to do anything that's sort of contradictory to where you want to grow, both in terms of geography and the client itself, the consumer itself, who we target as a Flow consumer. So we're very careful, and we've become more refined as we've gone forward. So I can't disclose where we'll be next in the US, but believe me, it is a huge focus for us.
Good to hear. So that kind of leads us to Starbucks. How is your partnership there? And potentially, the US market, when could that potentially happen?
Look, Starbucks in Canada has been working great. We really enjoy that partnership. Our sales, and again, in e-com channels and other areas, has gone up, and we know that Starbucks has had an impact on that. We hear great things from Starbucks themselves on the sales of our water versus the water they had been selling prior to Flow coming in. So it's been working really well for them as well, from what we hear. And so that's great. And, we did a presentation not so long ago. Nick did a presentation on sustainability and, ESG and Flow to Starbucks, and their entire US team was there as it related to sustainability and ESG. And they were very interested in the story, and they're following it closely in terms of what's happening here in Canada and the impact it's had on their sales and on their consumer base. So, again, nothing that I can speak to publicly or otherwise. Our goal would be to be with Starbucks in the US, but that'll be up to them. And if and when that ever happens, we will definitely let the market know for sure. But for now, we just continue to service Canada, and it's been working really well.
Very exciting. So, Flow brand is up 46% year to date. Help investors, understand what kind of growth rate do you think is sustainable going forward?
Yeah, look, quarter to quarter to quarter is always lumpy. We have seasonality, and last year we had a very lumpy set of quarters. So what we can do in Q2 at 98% versus 22, whatever Q4 will come in at versus Q1. But 46% year to date. Our goal is to be, 35 to 40% growth on a year to date basis this year. And our goal is to sustain that and grow it in the next couple of years. And so that would put us on a really great trajectory. And the more we can have in terms of, capital to put into that growth, specifically into the growth of the brand, the better. And that's, of course, the Aurora transaction coming off, which is that last pillar. And we believe if we continue to grow like that, puts us on that path to profitability within a not so long period of time as well.
All right, last question. Looking forward, what are the key milestones investors should be looking for in fiscal 2024?
Yeah, that's a wonderful question. The key milestones, are really going to be, can we sustain, a good growth trajectory that is above our industry? And our industry is growing, depending on which, it's functional water, premium water, sustainable water, sustainably packaged water. We want to be at the forefront of that growth. So that's something that people should be watching for, to see if we can continue to be a leader in growth. The second thing, though, and even I feel is even more important, is are our financials improving? Be below, sales. Are we improving our margins? Are we lowering our G&A and getting into, you see, improving EBITDA in that path to profitability? How is operational cash flow looking? And I think that's where the confidence is going to come from our investment community in general, to show them that there is a path to profitability, that we are a sustainable company, a going concern, continuing to operate and be healthy as time goes on. We need to be able to show that. And I think it's going to be very important for us to indicate through our financial results that we are just that, a very sustainable, healthy organization with a long path in front of us.
Brent, thank you very much for your time today. We appreciate it. Again, if you'd like to sign up for one-on-one meetings, please visit lythampartners.com/virtual and click the one-on-one meeting request button. We wish you all a good day and enjoy the conference.
Thanks, Joe.